take our conversation forward. Mahesh, what's your view on the market? Is this as good as it gets? Do you think it's a matter of time? What is looking okay will start looking not okay?
Yeah, thanks, Nikunj, for having me here. Yeah, I think that a lot of good news is priced in as we speak, and the market sentiments as of now, a lot of market momentum indicators, sentiment indicators look to be pretty good at this point in time. But if we take a 6-month, 9-month, 12-month view, very difficult to take a bullish call on the broader market, I would say at this point in time, given the combination of the kind of valuations that we are in, looking at the earnings growth, and also the other factor, which is the demand supply equation for equities. Demand has been good, but the equity paper supply has also been very strong. So keeping all these factors in mind, I would say most likely outcome over the next 6 to 9 months would be a sideways movement in the market.
What is your view in terms of where the market leadership is and how things are moving in terms of the earnings trajectory?
See, the earning trajectory we are looking at this year, FY26, is as of now, the expectations are at around 10-11%. Next year is slightly better at 13-14%. But as we always know that this is the expectation as of now, right? And during the course of the year, there is a good chance that we see these expectations getting revised downwards. Also, the other factor, Nikunj, that we will need to keep in mind is the nominal GDP growth. This year, FY26, the nominal GDP growth is likely to be in the range of around 9% or thereabouts. And that's because the real GDP growth is 6.5, but then the inflationary environment is quite subdued, which is a good news for an average consumer. But when we look at what that implies in terms of the broader corporate revenue growth and corporate earnings growth, it means that those numbers are not going to look as strong as they did, say, over the last couple of years. So, in terms of earnings, as I mentioned, so most likely we would end up the year maybe at around 10% or maybe lower than that for this year, and about say 12-14% next year. And if you contrast that with the valuations, I mean, the broader market valuations are at about 21-22 times, but those valuations have been, reasonable because of the banking and financial sector, which is a very large part of the index, where the valuations are actually very attractive, and that remains one of our top overweight sectors at this point in time. But if you were to look at outside of the banking sector, the multiples are in the range of 25, 26 times on an average. So yeah, so that's what I mean when I talk about earnings growth versus valuation equation is not looking like the best.
All right. Hi, morning, Mr. Nandurkar. This is Shrishti also joining in. But help us understand that how is the macro data shaping up? Because for now, the markets are standing tall. But if we look at some of the internals, when it comes to the GDP growth slowing down, when it comes to the GST collections, where we have seen a sharp moderation from those April levels as well, and add to that is the slowdown in the auto sales data. What is these data points telling you right now of the situation of the economy and its implication maybe on the markets?
Yeah, so the thing is, the fact that the month of June is not looking that strong was something that we were expecting, because as we all remember, this time around during this monsoon season, we saw the monsoon starting about 8 to 10 days earlier, and we all know that during the rainy season, the power demand, the construction activity, the cement demand, and a few other things actually do slow down. So in that context, the early onset of monsoon, while that's a great news for the broader economy as such, but it does have a negative impact on the June quarter, and which is, I think, what we are seeing as we speak. As a contrary, the September quarter is likely to be a very strong quarter for multiple reasons. One is that we had a very low base, first of all, of the last year September quarter. Secondly, there was also an excessive rains that impacted the last year's September quarter. And again, we have Diwali, which is early by about 8-10 days earlier, and so on. So there are some of these small factors which are depressing the June quarter and which will appropriately inflate the September quarter. So there are those like near-term quarter to quarter variations. But yeah, as I mentioned, if you look at on a full year sort of basis, FY26, the fact that the nominal GDP growth is going to be, one of the lowest numbers that we've seen in the last 15 years, barring the COVID years, of course, would mean that the broader growth expectations, whether it is credit growth, whether it is GST numbers, as you mentioned, or the corporate revenue growth, earnings growth, we have to have, a moderate view. And that's what the reality will be in my view.
Okay. Mahesh, what is the sense on FI flows according to you? I mean, flows have been quite robust.
Yeah, that I think is one of the strongest point, Nikunj. So I would say that one of the positive surprises for the market performance can possibly come from that side. So most part of the last financial year, we saw the FIIs were net sellers to the tune of around $1.5 to $2 billion every month. And in this year, FY26, we have seen that becoming minus 1.5 to plus 1.5 already. So there's almost a $3 billion per month kind of a positive swing as far as the foreign flows go. And we are all hearing about this weakening of the US dollar. Part of that is already visible as we speak, but there is more going forward, is what we believe. And when the dollar weakens, there is obviously a temptation, or obviously there is a move by the US-based investors or by global investors to move their money, move away a little bit away from the US dollar assets. We are seeing that happening as we speak, but most of that money which is moving away from dollar assets is going into Europe and Japan. Not much of that is coming into Asia or emerging markets or India in the quantity that it possibly can. So I think eventually, if this dollar weakness continues, it's very, very likely that the money which is going into Europe and Japan away from the US dollar will start coming into India, other Asian markets, other emerging markets as well. And that can be a source of positive surprise. So I mean, right now, I did mention in the beginning that my base case is that the market just moves sideways for the next 6 to 9 months. I think the risk to that cautious view is that if we see a big inflow from the foreign side, that is something that we will need to watch out for, and that does give you a risk on the upside.
To add to that, Mahesh, I wanted to gather your opinion on what is it that you're making of these promoter block deals that one is, seeing on a daily basis, and quite a sizable quantum, come to think of it. Almost, I think, about 70 to 90 odd thousand crore rupees has been offloaded so far. The fact that it's coming at sometimes even a steep discount to the market price of some of these shares, and the kind of IPO flurry as well that you're seeing in the markets right now, what's that telling you? I mean, is it just money changing hands, or do you think that's somewhere also indicative of a near-term peak perhaps in the markets?
I think it does indicate a near-term peak in my view. We are clearly seeing very, very large supply, as you rightly mentioned. We did see some of that in the second half of the last calendar year. So during the July to December part of the last calendar year, we saw equity supply in the range of around $7 billion a month. We actually have crossed that number already in the last couple of months. So the month of May saw about $7 billion a month. The month of June, we actually exceeded $10 billion. And nearly 75% of this equity supply is actually, as you mentioned, it's the secondary market transactions, meaning that the promoters are selling, or the private equity investors are selling. So that money is not going into the companies. That money is going into the hands of selling shareholders. And I think this is, the worrying factor to me, in the sense that this equity supply is not going to show any signs of weakness. There could be a few days, a few softer days. But our bottom-up analysis suggests that this type of $8 to $10 billion a month of equity supply coming into the market by way of promoter blocks, by way of IPOs, etc., can easily last for another 6 to 9 months, if not longer, because there's a lot of money waiting to be raised on the sidelines. So that's the other reason, why I mentioned that markets are unlikely to move up from here on because there is a lot of money or a lot of equity that would get offloaded into the markets, by all these factors. And I think in my view, it's a healthy change of hands because I believe that in the absence of the equity paper supply, the valuations can skyrocket. I mean, they're already on a higher side as we speak. But if the equity supply were not to be there, the valuations will go up even further, which is not a very healthy sign according to me. So I think what's happening today is in my view, something that should happen, and I'm glad that it's happening.
Fair point. But I mean, I wish one could say the same about the upcoming earnings season, though, Mahesh. What are you largely penciling in? Where could be the disappointments? Where could be the surprises, if any?
Um, well, as I mentioned, the fact that we have seen the early onset, of monsoons, that will have a negative impact on, or has already had some negative impact on, as I mentioned, the power demand, the construction activity to some extent, and the related sectors. Also, the other factor to keep in mind is that the low inflation environment that we are currently in is also not that good for the retail companies or the consumer staples companies because for many of these companies, a reasonable part of the growth also comes from price increases. And in a low inflation environment, the price increase component goes down as well, and therefore the growth also goes down. So yeah, so I would say staples, retail, power, some of the industrial activities, related companies could see a bit of a softer trend. And on the positive side, therefore, we continue to like banks and NBFCs. That remains one of our top overweight sectors. We like telecom. That's one of the most attractive consumer segment. Not many people view telecom as a consumer sector, but it is a high growth consumer sector in India. So that is something that we like. We also like cement more because of the fact that we are finally beginning to see some reasonable price momentum, the cement price momentum, I mean, in the physical market. So those are the three top ideas that we have from the sectoral standpoint. Also, some select real estate names as well. So yeah, that's what we like.
But Mahesh, just also help us understand that what is that you are tracking globally, especially with respect to the US markets, because for now it's not just India, but even the US markets are at all-time high with respect to S&P as well as NASDAQ, and investors are waiting for that July 9th deadline to hit in, and of course the final pass-through of the Trump's big beautiful tax bill as well. Do you believe that most of the nervousness with respect to that is already priced in, or there could be some factors that could be at play in the times ahead?
No, I think the market at this point in time seems to be more optimistic about the 9th July outcome. And that's why, as you mentioned, the market's at an all-time high. So I don't think that the nervousness has been priced in because I don't think there is any nervousness about the deal as of now, at least from the market expectation point of view. So clearly that's an event to watch out for. But I would say from the from the equity market standpoint, one of the key, I mean, there are like many global factors that one can keep a track of, but I think the most important global factor to keep track of is DXY, which basically indicates how strong the US dollar as a currency has been or is likely to be. And I think that's a very, very important, driver for equity markets globally, especially in the emerging markets and the non-dollar assets in the likes of India. Because if the dollar keeps weakening, I would say that there's a good chance that the foreign flows, which have already turned positive over the last 3 months, can strengthen even more from where we are. And that could bring in some positive cheer for Indian markets.
All right, but Mahesh, post-COVID, select themes that have been that has already given multi-bagger return to the investors. Just wanted to have your take, and the top of the sectors that come to my mind are defense, railways. What a return these stocks have given to the investors. Help us with your take on that, because specifically for defense, the view is quite divided. The valuations are rich, but there's still a long headroom of growth. How do you see these sectors which have already done well?
I think defense looks like a very, very strong theme from a medium to long term perspective. It's a global theme. It's a theme that should play out in India also. And you're right, the valuations have gone up, but I think the growth outlook looks very, very strong. At this point in time, India's defense capex as a percentage of GDP is 0.5%. If you look at the last 15, 20-year data, this number has ranged between 0.5% of GDP to 1% of GDP. And so at this point in time, we are clearly at the lowest end of the historical range, which is 0.5. I think given the global geopolitical situation and also the situation around India's own boundaries, I think that number needs to be on the higher side of the historical range, not on the lower side, which means closer to 1%. So I believe that if we were to get to that number, say over the next 3 to 5 years, it essentially implies that the defense capex in India over the next 5 to 7 years can grow at a rate of 25% plus, and plus 25% plus on a CAGR basis. And on top of that, there are these other themes like indigenization. Also, there are some small exports, which are also happening, as we speak. So, on an overall basis, it's a very strong theme. And yes, the valuations have gone up, but I would still like to play with that theme.
All right, Mahesh, also just wanted to have your take on the other asset classes as well, because of late we have seen the gold shining bright, and some of the other commodities have also been doing well. Crude has its own story at play. But where do you see the money flowing? And also, will you agree that money has already moved from gold to equities of late?
Maybe from a very short-term perspective, yes. But once again, I would bring in my point that I already made, which is on the dollar weakness, the DXY. So if the DXY keeps weakening, I think the money will come into gold once again. So given the fact that gold has already rallied so much in the last sort of 12 to 18 months, maybe it's taking a bit of a pause, a bit of a breather. But if one assumes that DXY is going to be a weaker currency, then it means that gold will start to shine once again. So that's our belief is. And as for the other commodities concerned, as I mentioned, cement is something that we like quite a lot from the market perspective. And we also like metals as a way to play the China recovery story as well.
A lot of moving parts, and we'll continue chatting and tracking that. Mahesh, great to have you on the show today and get in your insight on all that's going on with the world.
Thank you very much.
Okay, let's just get you a status check on